the pillar of the tech world. This is the company everybody thinks is untouchable.
Whatever yeast story you can concoct to keep Apple up is what they're doing right now.
Or don't fall for that same trap. Apple stock, guys. Warren Buffett's buying it. Everybody loves it. It's considered the pillar of the tech world. Our belief is we will see a bottom in the market when people have given up on Apple, okay? Apple just reported earnings, and they missed on earnings, EPS, and revenue for the first time in 7 years. Yep. This is the company. This is the company everybody thinks is untouchable. So the question is this an indication of the world economy? People aren't selling as much? They missed out? I don't know. But we're going to use our software to check out Apple. So let's pull it up in our software. Now, here's why Warren Buffett loves Apple. You ready? 5-year return on invested capital, 38%. 1 year, 53%. If you're new to this channel, this is something really important to look at. What this says is Apple gets a really high return on the money that's in the business. A company with a really high return on invested capital. Our goal is 9% over 5 years. This is 4 times higher. This means they have to spend less money to grow than other companies. And they can use that extra cash they save to buy back shares when the stock is cheap, to pay dividends, and to do other things that are much more valuable than to constantly reinvest back in the business to grow it. Buffett and Munger like investing in businesses that take less capital to grow. And it makes sense. It makes a lot of sense. You don't want capital-intensive businesses. You don't want to own businesses that have to take the cash flow it generates and resuck it, put it right back in the business just to stay where it's at. You want to find, and software businesses tend to have high return on invested capital. Apple is a hardware business, but it's a very high margin. I mean, look at this, 43% on hardware. That's pretty good. Look at this difference. Their profit margin, very consistent, and it's very close to their gross margin. That means their overhead is a very small portion of the revenue. But guess what? The revenue is $390 billion. All right. They pay an adorable dividend of 0.6%, which pays out $15 billion of their $81 billion in the last 5 years each year free cash flow. That's a big thing, guys, if you're new to the channel. Dividends aren't always secure. You need to compare the dividends to the free cash flow. If that's something alone that you like, guys, we talk about things in a different way. You need to subscribe to the channel and learn about how to invest. Okay? Investing isn't just saying, I like Apple, therefore I like the stock. The stock and the company are very different things. You want to buy the stock when the stock price is so low that it's not in line with the long-term actual value of Apple is. The easy part of that is just saying that, figuring out the value for Apple. The hard part is when you see Apple fall from $151 down to $100 and say, I still believe it's worth $150 or whatever price you come up with. Now, for those of you who are new and watching and saying, Apple will never hit 100, I'd like you to go back to our 2000 videos and look at all the stocks that we said would fall. I don't think a single one hasn't fallen to where we thought it would go and lower.
You're right.
And people said to us, it'll never hit that. The biggest example was Google and Tesla. What's happening with Google and Tesla now, literally people said, you're crazy, it'll never happen. Okay. And we still think Google and Tesla have more to fall. Mm-hmm. But one's a better value than the other. We won't get into that right now. But right now with Apple, go ahead.
So the funny thing about Apple is, it's right now in this market, it's bad news is good and good news is great. And Apple's earnings were a lot better than they look. Therefore, it justified the price bump. I mean, you look at this and say, oh man, the iPhones, it was so bad out there that the iPhone sales, right? Well, now now they have 2 billion devices out there in people's hands. So it's fine. Don't worry about that. And it just goes, the story goes on. Whatever story you can concoct to keep Apple up is what they're doing right now.
Or whatever story you need to concoct to justify the price.
Justify the price, yeah.
The price is up. Therefore, you find the stories. Like today I saw Tesla's been upgraded at a bunch of companies. Why? Because Tesla's rebounded a ton.
Yeah, the price is up.
Yep. It was at 100. Now it's at 193. We need to justify that. Mm-hmm. Don't fall for that same trap. I used to fall for that exact trap. I used to think all these analysts were brilliant. They knew so much. No, that is not the case. They're just following the news like everybody else. You need to be different. Let's go check out the 8 pillars on Apple. All right. So guys, we only have 2 X's here, and they're both our major valuation metrics. The 5-year PE is 32. The 5-year price to free cash flow is 30. So they're reasonably close to each other. Everything else, this is what Warren Buffett loves. He's going to love this share buyback. Mm-hmm. I believe Buffett's buying Apple sub 140. He's going to and look at him. He's going to continue buying it even if they report worse earnings and all that stuff, right? Because in the long run is what he's worried about. Cash flow growth of $35.5 billion, net income growth of $35.5 billion. I love seeing that the net revenue, the net income and cash flow has grown the same amount. That's beautiful. Revenue growth, and look at their debt. They can pay off all their debt with 1.9 years of their last 5 years of free cash flow on average. What was that, Mo?
Amazing.
Isn't that incredible?
Yeah. The last two companies we've looked at, Meta and Apple, I mean, they're both in the same situation as far as paying off their debts.
Yeah, and guys, when things get tough, companies that have a lot of debt are going to get in worse trouble.
Yep.
Debt's okay. Debt is not a bad thing. But just remember that when times get tough, the ones with the most debt have the most problems. It's leverage. It's great during good times. It's bad during bad times. Keep in mind, though, I use leverage, and I'm okay with my leverage because I feel like I take appropriate levels of leverage, okay? Let's go check out what the analysts are saying about the company. So they're estimating that Apple will make $6.36 per share this year, growing to $8.84 in the next 4 years. That's a growth of high single digits. Wow. Okay.
Not a lot of analysts on this.
Not great, not terrible.
Surprising.
And then revenue growth, again, high single digits. Yeah. Okay. Now, guys, this is the stock analyzer tool. This is the most popular part of our software. 1.3 million people used it last year alone. Uses of this from our community. This is what determines, without including the balance sheet, what price to pay for the company, just based on the cash flow, because every investment is the present value of all future cash flow. This software is incredible. It has all of these tools up here we didn't even go through. So if you're interested in the software and you've always thought about it, we have a new special, 7 days, $7. Try the software for 7 days and $7. It's $1 per day. You can try out the software. If you love it, great. If you don't, you cancel. Everybody's fine. But I guarantee it'll change the way in which you look at investing, especially with this EM community here with thousands of people engaged to talk about these companies. So Mo, why don't you do a 10-year analysis and I'll do a 20-year analysis on Apple. And the reason I do a 20-year is Apple's the kind of company I want to own forever. This will become a blue chip company. This is going to become the future of blue chips. I think a lot of these tech companies are the future blue chip companies. So I want to own this thing forever. So I want to analyze it like I'm going to own it for a long period of time. And 20 years is a long time. So let's go with revenue growth. So guys, these are the things we're doing. We're sitting here and taking our assumptions about the future. Revenue growth, profit margin, free cash flow margin, assigning a PE to the end for a value, and then getting our desired return. The desired return essentially is your margin of safety. The higher your desired return, the more margin of safety you have, right? Because in order to get a high return, you need to pay less money for the investment. If you pay $1 for something or pay $10 for something, the exact same thing, the one you paid $1 for, the person who paid $1 will make a lot more money as a return than the one who paid 10. Mm-hmm. So Mo, tell me your assumptions here on revenue, and I will do mine. Same thing.
So revenue, I did 6, 9, and 12.
I did 4, 6, and 8.
Okay.
For 20 years, and Mo's doing 10 years.
Yep, 10 years.
Profit margin.
22, 24, 26.
I did 21, 24, 27.
Okay. 24, 26, and 28 for free cash flow margin.
So it's funny. I went higher. I went 22, 25, 28. So the reason I did higher is their free cash flow has been pretty consistent and higher than it's earned, and then it's on profit margin.
Yep.
PE.
15, 16 and a half, and 18.
It's like we're brothers, Mo.
Oh, I didn't even look
15,
at yours.
16 and a half, and 18.
Same for price to free cash flow.
And remember, guys, the long-term historical average is 15 for a company, but a company that has a high return on invested capital should get a higher PE, and that's why we put in these higher multiples here. Yep. And finally, desired return.
I did 11, 12, and 13.
I did 10, 12, and 14.
Okay.
And by the way, guys, the longer you go out, the bigger and bigger a difference it is on these returns. Mm-hmm. So hit the analyze button.
All right, let's see.
Mo, what'd you get?
92 to 100 on the low end. 164 to 177 on the high end, middle ground about 124 to 134.
Before I go through my numbers, what that's saying there for Mo is if his highest assumptions hit, you should be if God came down right now and said, Mo, these are going to be your numbers for the next 10 years. The balance sheet won't change. The number of shares won't change. You absolutely need to buy that company because you're going to make a 13% return on your money.
Yep, and that's what you're willing to pay for right now.
Right, exactly. So I hit the analyze button. Here are my numbers. You ready?
Yep.
Low side of 85 to 90.
Okay.
High side of 118 to 122. Middle of 100 to 105. I have it in my watch list at 125. Not because I'm buying it at 125, because I'm going to start selling puts at 125 at much lower values. Yep. Now, here's the deal. Let me show you what Warren Buffett sees. He's looking at intrinsic value of 10%. He probably believes more like this.
Yeah.
That's why he's buying it, because he has so much capital that he's okay buying companies that have a high return on invested capital and paying a premium for them. All I did here was change my desired return to 10% across the board. That's essentially the intrinsic value.
Yeah.
So guys, check out, before Mo goes, there's a high, go check out the charts on Apple.
So the reason I just want to show this is for a lot of stocks in the market. We're seeing this this upward trajectory. And look, this is the last couple times that Apple went for these crazy runs. Straight up, and it just trickles down on you. Straight up in a matter of a couple of weeks, trickles down on you. You're kind of seeing that same thing right now. So my point in saying this is don't just get so excited and say, oh, I'm missing Apple. It was at $129 a couple of weeks ago. Now I can't buy it. Just be patient, guys. This stocks go up and down erratically. And that's exactly what this is doing right now. It's what Meta's doing. It's what all these tech companies are doing. It's what the NASDAQ's doing.
The QQQ, the NASDAQ ETF, is up 15% year to date. That's not reasonable for 35 days. So guys, if you like this, subscribe to the channel. Check out everythingmoney.com for 7 days for $7 special. Thank you very much for your time.